I am bringing special guests that have tremendous amounts of investment experience, and I'm very excited to have a good friend of mine, Tom Berry, on the show with us today. Tom is probably one of the leading figures in, I would say, real estate investing in the state of Texas, and I have known him for about 10 years now. Highly respected, a wealth of knowledge, and we cannot wait to get him on the program here. So before we do that, though, I want to go over just a couple slides in case you are new to the program. NuView Trust Company, we are a licensed and bonded trust company that manages and administrates self-directed IRAs. We put the keys in our client's hand when it comes to picking investments for their retirement assets. And our clients do very well investing in alternative assets. One of the things about self-directed IRAs, though, it's an entrepreneurial type of retirement account. You have all the investment decisions to make. That's good, and that can also be bad if you're not doing your due diligence or really just not identifying the right investments to put into your retirement account. So this class, this workshop is going to be geared towards identifying what types of investments fit well, whether it's inside or outside of an IRA, and identifying opportunities that may be active investments and passive investments. And it's a really, really important topic, especially when you talk about self-directed IRA investing. So let's just get into it, and then I'm going to bring Tom on here in a second. When we talk about self-directed IRAs, if you're new to the program, don't get confused with this term. When I'm talking about self-directed IRA, I'm just talking about an IRA, an individual retirement account. The great thing about individual retirement accounts is we get tremendous tax benefits by investing within an IRA, whether it's a traditional IRA, a Roth IRA. I'll tell you the different types of accounts that we have here at NuView Trust Company. But the reason we call it self-directed, it's just a marketing term that signifies that you are the decision maker when it comes to your investment decisions. We still act as the custodian because you have to have a custodian that manages or holds the assets until you take distributions. But the spectrum of investments is much, much larger in a, quote, self-directed IRA because you're not limited to the traditional investments like stocks, bonds, mutual funds, and CDs. So the product we have here is self-directed. You hear this term a lot, but really what we have underneath all this is just IRAs or retirement accounts, just like your Fidelities and Charles Schwab's. What's the benefit of having a self-directed IRA, though? If you're looking to diversify your overall portfolio, and you probably hear this term all the time, that diversification is one of the most important things when you are investing. Most people think diversification when it comes to their retirement is having some high risk mutual funds, some low risk mutual funds, and then maybe some medium risk mutual funds, and voila, you're well diversified. True diversification is probably having some of your retirement invested into those assets, because those are paper assets. They're good and bad, depending on where the market's at. But the opportunity to invest outside of the market and invest in tangible assets like real estate, notes secured by real estate, investments into small startup companies or private companies, oil and gas interests, cryptocurrency. There's a whole host of alternative investments that may fit well in your overall portfolio. So you don't have to be an expert in investing to understand that a self-directed IRA gives you more options. And often the options in a self-directed IRA are more tangible than, say, a stock or a mutual fund. The biggest benefit with self-direction, though, is just the tax savings. This is very, very important because if you are an investor by trade, say you're a real estate investor, you get better tax treatment by investing in real estate through your retirement account. Doesn't mean it's bad to invest in real estate outside of a retirement account, but there's definitely benefits we get inside of an IRA that we don't get as tax-paying individuals. So we do a lot of education here at NuView to talk to people about, it's not about how much money you make in investing, it's about how much money you keep. And you keep more money when you can eliminate Uncle Sam out of the equation. And one of the easiest ways to do that is just use your retirement accounts when you invest. But the biggest benefit about a self-directed IRA is it allows you to invest in what you know best. We bring on lots of guests and investors who by nature are phenomenal investors in their trade. Today, we have a phenomenal real estate investor who's done all sorts of things when it comes to real estate investing. And an individual like that can make better returns for themselves investing in the things that they're knowledgeable about through their retirement account versus just investing in the stock market. So when you look at your overall portfolio, ask yourself the question, are you investing in things you're knowledgeable about? And if you're not, try to find something you are knowledgeable about and realize you can use a self-directed IRA most likely to invest in that. I'll talk about the types of investments we see most commonly here at NuView here in a second, but these are the accounts that our clients use to self-direct. We have 7 types of accounts. We've got personal plans, traditional IRAs, and Roth IRAs. We have employer plans. If you're self-employed, you can self-direct your own solo 401k. You can self-direct a SEP IRA. You can self-direct a simple IRA. And we even have non-IRAs, which would be your health savings accounts and your education savings accounts, which help you pay for health expenses with tax-free dollars and education expenses with tax-free dollars. All 7 accounts are considered tax exempt. They're tax exempt trusts. Some work better than others, depending on what you're investing in. But if you're maximizing these accounts, you're going to find that you give less money to Uncle Sam, and getting to retirement is much, much easier. So these are the plans that can be self-directed. And what can they be self-directed into? Anything except 2 investments: life insurance contracts and collectibles. In the IRS code, they don't tell us what we're allowed to invest in when it comes to our retirement accounts. They only tell us what we're not allowed to invest in, and the list is really short: life insurance contracts and collectibles. General rule of thumb is if you can hold title to an asset, you could drop a purchase contract to buy it. You can buy it in the name of your IRA. Here's the most common investments we see here at NuView. We see clients use their IRAs to buy real estate, all types of real estate: foreclosures, tax liens, apartments, real estate options, condominiums, land. We see clients do more passive investing through notes, whether it's a secured note secured by property, secured by equipment, or an unsecured note. Interest payments and being a passive investor, it works very well for a lot of people. We have a lot of clients that invest passively into entities like LLCs, partnerships, and joint ventures. And a lot of times those entities are owning real estate. There's a lot of people out there that raise money through syndication and buy apartment buildings, and they give people who have retirement accounts the opportunity to invest in those investments through a self-directed account. And we even have the ability to invest in cryptocurrency through a self-directed IRA. And what a wonderful thing. If you love cryptocurrency, how about buying and selling cryptocurrency with no capital gains tax? All of that's possible within a self-directed IRA. Today, we're going to talk a little bit about active investing versus passive investing. This is a really, really important subject to understand, because most of the investors that I know that are the best investors right at the summit they do both. They understand that there's active investments that they want to focus their energy on, and there's passive investments. Tom Berry, Tom, you on?
I am.
How are you doing, sir?
I'm doing very well, Nate. Thanks for having me on.
Yeah, I want to give you the reins here, but I just want to give a little intro to everybody out there. I've known Tom since 2012. I highly respect it. I regard him as probably the most knowledgeable and honest real estate investor that I've ever met. And I'll just give you a little story. We had our investor retreat, and Tom was invited to be our day 1 speaker. He talked about due diligence, and we had a day 2 speaker that ended up not being able to show. And Tom's just so good. He said, I'll take that presentation, and just did that topic because he's just a wealth of knowledge. He does all sorts of things. And I'm just so grateful that he's spending some time with us today. Tom, thanks again for everything you do for us at NuView, and I appreciate you spending some time with us.
Absolutely. Well, Nate, thanks for having me on. I really appreciate it. I'm going to do a screen share here. Again, thank you, Nate and NuView, for allowing me to come on here and share a little bit of information with you. I titled this thing the difference between passive and non-passive investing. But really what I want to do is just kind of dig into some of the various real estate investments and strategies that we can do in a self-directed account, and categorize them and talk about how would we go through the process of deciding which one is best for us. right? So a real quick little disclaimer here. Obviously, this is not a solicitation of an investment of any kind. Obviously, this presentation is intended for illustrative and educational purposes only. It is only my opinion, and that doesn't mean that it's going to be, right or wrong. I'm just going to share my opinion after years and years of doing this thing. I am not approved or endorsed by NuView Trust or any employee of NuView, and I want to make that very clear as well. And these are really just going to be some hypothetical scenarios that we go through, not really indicative of any particular actual investment. I would also want to say that nothing I say in this presentation should be perceived as tax, legal, or investment advice, simply because I am not an advisor, I'm not an attorney, and I'm not a CPA. So obviously I would not be qualified to give that type of advice. So with all of that out of the way, a quick introduction. I am the CEO of a lending company, which is Investor Loan Source, and also a capital company called ILS Capital. And quite simply, what we do is we raise capital at ILS Capital from passive investors, and then we lend that capital out to real estate investors through Investor Loan Source. So the two companies really work hand in hand, and I call it money in the front door and money out the back door, basically. A little bit about me and my experience so that you can maybe understand where I'm coming from as I go through these remaining slides. Investor Loan Source is a Texas-based family-owned and operated real estate and lending company. Our company actually lends to real estate investors in 18 states of the United States. And I always say I'm an investor first and a lender second. My business partner is as well. Between Donald and I, we currently own either all of or chunks of over $50 million of real estate. So we practice what we preach when it comes to real estate investing. But we also lend as well. And I'll talk about kind of the differences between those two and where they fit into these different buckets as I go along. If you want to do any more research on us or our companies, there's some websites that you can jot down. And that's it for that. Let me get into the actual meat and potatoes today. So I'm going to talk about the difference between passive and active investing. And I'm going to throw a third one in there that you may not have heard, and that's semi-passive. But I want to make clear that I am not talking about the IRS definition of passive investing. So please, let's not confuse the IRS definition with what I consider to be the real definition. So the IRS says passive activity is an activity that a taxpayer did not materially participate in during the tax year. It defines two types of passive activity. One is a trade or business activity to which the taxpayer didn't actively contribute, and the other is rental activities. Now, I got to be honest with you, at one point in my real estate career, my wife and I owned about 89 houses and over roughly 330 to 50 apartment complex units. And I know the IRS says that was passive, but I'm here to tell you that was not passive. That was not passive in the real sense of the word. So we're going to talk reality going forward in our talk here today. We're not going to talk IRS definitions. So in reality, I think there are three categories for real estate investing. We talked about active. So what are examples of each of these? Well, if you're an active real estate investor, you might be a wholesaler. That is somebody that goes out and digs up a good deal, gets it under contract, and then sells that contract to another investor that actually wants the property. So in that case, the wholesaler is basically just a bird dog. They're out there kicking the brush and looking for a good real estate deal and bringing it to market. Now, you might also have an active investing career if you're a flipper. right? Everybody's seen the shows, flipping houses and so forth. Definitely an active investment because you have to be intimately involved in that activity in many ways in order for that to be fruitful for you. There's another one, and my assistant actually looked at that and said, Tom, I think that's a typo. You have wholetailing there. No, that is actually a real estate term. Somebody made up this word along the way. And what it means is getting a contract and purchasing a property that needs some work, but not doing the work. So basically, you get it under contract, you purchase the property, you just clean it up a little bit, literally sweep it out, clean out the debris, whatever debris there might be, and then throw it on the multiple listing service in the area and sell it as a retail sale. You're not really wholesaling it because you're purchasing the property, but you're not really flipping it either because you're not doing all the repairs necessary to bring it up to proper standard. You're just doing something in between that we call wholetailing. And again, that is a very active strategy. All of these can be done in an IRA, although for many reasons, I wouldn't recommend it. And we'll talk about that as we go along. I think when we talk about self-directed accounts, most of the people that I know with self-directed accounts are going to fall in one of the other two categories here, either in the semi-passive or in the passive role. So semi-passive, examples of that might be having rental properties. Now, I would say if you're using a third-party management company for your rentals, or let's say you're doing short-term rental like through VRBO or Airbnb, and again, you're using a management company for that, I would say that that's probably going to fall in the semi-passive category, but rentals could also fall in the active category if you're self-managing. If you're not using a third-party management company and you're having to do all of that, I would say that those rentals are going to fall in the previous category under active investing. Another semi-passive that a lot of people with self-directed accounts use is the note investing or private lending. And I'll kind of look at those in the same bucket as we go on. But I think, for me, the difference in delineation between note investing and private lending is simple. In note investing, you're purchasing a note that has already been created. So you might purchase a note from a bank. You might purchase notes from hedge funds. You might purchase a note from another private lender. Or from a hard money lender. But in that case, it's a note that has already been originated and is already active. Now, in the note investing, we could split that down a couple of ways as well and say there are performing notes, that is notes where the borrowers are currently doing what they're supposed to do, right? They're paying as agreed in the contract, in the paperwork. And then there is the non-performing note, which is where you purchase a note where the borrower has stopped paying or are in default in some other way. Maybe they haven't paid the taxes on the property. Maybe they have let the insurance lapse, or maybe they've let that note go to term and haven't paid it back yet. Those would all be things that would trigger a default situation, and we would consider those notes to be non-performing. Again, purchasing notes would certainly be a semi-passive investment. And we'll get into all of these in a little bit more detail as we go along. And then private lending, again, another semi-passive. You are not only investing in a note in private lending, you're creating the note. You are actually originating that loan. So there is a lot more work that goes into the private lending side of note investing than actually just purchasing notes that are already created. And again, we'll get into that in a little more detail, but I kind of wanted to set the stage here by giving you some definitions before we get into it any further. Now, in the final category, we have passive investing. And passive investing to me is you don't have to do anything beyond the initial due diligence for the transaction. Again, we'll get into that in more detail. A couple of examples of that would be A, fund investing, and B, syndications. Now, Nate, in his introduction, talked a little bit about syndications, and we'll get into it a little bit more in more detail. And then I'll also cover fund investing. Now, when I look at these three categories, and when you look at them, I am sure we could come up with at least another dozen examples of real estate related investing strategies that we could categorize and throw into one of these three buckets, right? But I think that anything we came up with is going to fall into one of these three. So the question becomes, which one do I do, right? And it's a question that's going to be different. The answer, rather, is going to be different for every investor. Which one do I do? And I was, talking to Nate earlier today when we were talking about the program, and I made the comment, and I want to share with y'all, this is not an indictment or an endorsement of any of the strategies we're going to discuss. And I'll tell you why. Because I have either done in the past or are currently doing every single strategy that I have on the screen right now. I wholesaled when we got started in real estate. I flipped for years. I did a few wholesale deals along the way. As I mentioned before, I had a ton of rentals. We have bought notes performing. We've bought notes non-performing. And certainly we do a lot of private lending. I believe we closed about $191 million worth of private loans just last year alone. Fund investing, we are invested in funds, my business partner and I. I have done syndications, and we currently run two private equity funds as we speak. Our two funds currently have over $42 million of investment capital in them. And we can talk about those a little bit further as well. So I'm not here to say any of these investment strategies are good or any of them are bad. I think that they all have their place, but at different times. So, before I also go into this, let me say one more thing on this slide. When you start out in real estate, oftentimes you don't have any money, or you don't have a lot of money. That certainly was my case when I started out, some 15 years ago in real estate. We didn't have a lot of money. So what we did was those active things that would make us money and make us income. Once we got that rolling, and my wife and I had enough to live on, enough to put back a little bit, then we started getting into some of the more semi-passive with rental properties. And we had a property management company that we created for the sole purpose of managing our own rental properties. So for she and I, it was a more semi-passive role because we had employees that were doing a lot of the work for us at that time. As we went on and on and on, and we started putting back a little bit more, we started creating a little bit of net worth and wealth for ourselves. We found ourselves wanting to do more and more passive strategies, right? We didn't want to be out there in the trenches, digging up the deals anymore. We didn't want to be walking the ugly, stinky houses that needed flipped. Those were activities that certainly we were willing to do when we needed to, but when we had the choice, we quickly moved into the more passive roles. And I think that, we talk about that in our real estate circles as the evolution of the real estate investor, right? We start out where we have to start out, but ultimately, I think most people have the goal of getting to that final third category of passive investing. Now, semi-passive versus passive. Again, I'm introducing a new term in semi-passive that a lot of people don't use in our circles, and maybe you haven't heard that concept. But for me, the difference between the two is really simple. Semi-passive investing is something that relies on you and your knowledge for all the decision making. Passive investing leverages the expertise of someone else. And when we get into the passive categories here and talk about them in detail, I think that will be more clear for you. But for me, the difference between those second two categories is going to be just that. It's going to be the knowledge level that you have to have as an investor to do one or the other of those things. So all investment types have their place, right? I said this is not an indictment or endorsement of any of them. But I think for everybody, you want to decide, is this particular investment that I am looking at, is this investment that I have been offered by someone suitable for me? And is it suitable for me now? So two-part question, right? Is it suitable for me? Does it fit my risk profile? And then secondly, is it suitable for where I am in life now? So let's talk about some of the things that we might use to ask ourselves if this is a suitable investment and is it suitable for me at this moment. Number one is risk profile. How risky is this investment? How much potential do I think this investment has to not return me a return, and worse yet, not return me all of my initial principal? Because we're not talking about saving here, are we? We're talking about investing. And obviously, all investing by its nature has an inherent risk to it. So that's the very first question that I asked myself. And I think deep down, everybody asks it in their own way subconsciously, even if they don't ask it consciously. The next one is availability of time. In other words, how much time is this investment going to take away from me? I believe firmly, and most successful people believe, that our most valuable asset is the minutes we have in a day. And because I quite simply cannot go make any more of that. Money I can go make more of, but I can't make any more time. I have a finite amount of it. And in a crazy twist of fate, I don't even know how much of that there is for me. So for me, my time is extremely valuable. And so when I look at an investment, as I was looking at an investment yesterday that a broker sent me, and my response back to them was, this was really interesting. I went through the whole package and I actually did a little bit more due diligence outside of that on it. But at the end, I decided that for the amount of return, the amount of time it would take me was just too management intensive. It would just take too much of my time for the return that I might be able to yield off of that investment. And she understood that completely. And she's like, you know, I was thinking that when I sent it to you, that it was probably too small of a deal for you, but, you know, I thought I'd throw it to you anyway. So I think we should always go through that little check when we're looking at an investment. How much of my available time is this going to take away? Next is, how much knowledge do I have to have of this investment to be successful in it? And as we go through some of the different investments here, that will, excuse me, that will again become a little bit clearer as well. But each investment strategy requires a different level of knowledge from the investor. Next one, investment time horizon and payout or payback frequency. So let's dissect that one, because that's a mouthful. Investment time horizon. I'm buying a piece of property and I want to flip it. We'll go back to active investing just for a hypothetical here. I want to flip it. Well, I know that it's going to take me so many days to get this thing closed. It's going to take me so many days to get it fixed up. It's going to take so many days to market it, and then so many days for the buyer to close on that property. So it's going to be X number of months before I see any payout and before I see my payback, which, by the way, in that particular scenario are going to be the same, right? Because I'm not going to get paid anything until I sell the house, the buyer closes on it, and I get all of my money. So I'm going to get all my money back. That's payback. And before I get any of my payout, which is my earnings off of that particular investment. Now, you might, let's look at a private equity fund investment. In the private equity fund investment, you might invest your money today. It sits in escrow until the first day of the next month. And then after that, you get your payouts on a monthly basis until you take your money back out. So that's going to be a very fast payout, right? Monthly, starting in a month or so. And payback is at any point you decide that you want your money back after the initial lockup period, which we'll talk about lockup periods later. But once you have done that, you can take it out at any time. So in that scenario, it's going to be completely different than the scenario of the flip. If you are on a fixed income and you are living off of your investments, you certainly want to take this into consideration, because there are investments we'll talk about that might not pay anything out for 5 years or 6 years. And then at that point, you get all of your principal plus all of your earnings in a lump sum. Obviously, that would not probably be the right investment for somebody that is trying to live off their investments. That's quite a stretch to go without a check. Life stage. I think this one's important and not talked about enough. In real estate, we have this thing we call the shiny object syndrome, where we go to an event or we get online and we hear somebody talk about something that just, it sounds cool, right? It's an investment strategy of some type that we've not heard of before, or we never really thought about before. And man, the way this person delivered their talk, it just sounds cool. And I'll bet it would work. And I'll bet we could make a lot of money off of this. But at the end of the day, where you are in life, is it congruent with the amount of work and intensity that you would have to put into that strategy? I think about this a lot because the older I get, the lazier I get. I'm just going to be honest about it, right? At this point in my life, I've been blessed to have, reasonable success in real estate investing. And I just don't want to do things I don't want to do anymore. So if that is true, and I guarantee it is, then that just wipes out a whole lot of investment strategies for me, simply on where I am in life, my stage in life. There are simply strategies that I will not consider because I just don't want to do them. And I think that everybody has that deep down, right? There are just certain things we don't want to do at this stage in life. Doesn't mean that we wouldn't want to do it at some point, or maybe we would have done it at some point in the past, but now just isn't a time, just not the time for it. There are two other things that I think we need to consider when we're looking at an investment strategy. I'm not going to cover them in any more detail than here, but one is our global portfolio makeup. Again, in the introduction, Nate talked about diversification, and that's really what we're talking about. Global portfolio makeup simply means looking at all your investments. That's your global look, right? You're looking at all your investments and you say to yourself, man, I'm really heavily tilted over here, or I'm really heavily tilted here. And because of that, I may want to look at a strategy that I wouldn't ordinarily look at, simply because I want to add an element of diversity to my real estate portfolio. And I think that that's a very valid reason to look at a strategy when in conjunction with all the other things that we're talking about here. And then the last one, and I'll talk about even less, is because I'm not qualified, is tax treatment. Every strategy has a different tax implication. So you want to make sure that you talk with your CPA or your tax person to see how that's going to affect you and your portfolio. All right, so now what I want to do is get into some of these different strategies, and we're going to talk about them, and we'll grade them, or we'll profile them, if you will, on 4 things. Given this page, we're going to look at the risk of them, the time intensity, the knowledge of investment, and the payout frequency and investment horizon. And then we can draw some conclusions as to pros and cons of each one of these strategies. So what I always hear people say when I travel the country and go to different real estate events and different trust company events is I hear people say, I want to invest in, and then you can fill in the blank, right? What I think we should be saying is, I should invest in, fill in the blank. Because I want to invest in may not actually be backed with a logic-driven analysis like we're going through here. But I should invest in, hopefully that is backed up by some analysis and some logic that brings us to a conclusion that is not based on just what we feel or what is cool or what we would enjoy. I do a lot of investment strategies that I just quite honestly don't enjoy, but I should do them because they're good strategies. They work. They're going to fit with my time, risk profile, knowledge, etc. So active real estate investing, this is a brief list of some of those. I'm not going to go into any of them because quite honestly, like I said before, I don't see a lot of, there are some, but I don't see a lot of active real estate investing in the trust accounts, in the self-directed circle. Certainly those of us that have been active real estate investors for a long time will do some of that in our accounts. But if you're not an active investor or you haven't been an active investor for quite a number of years, this probably isn't something that you're going to want to do in your trust account. Here's why. Active investors have either a job or a business. If they're small active investors, I will say they have a job. If they've grown that active real estate investing business into something larger where they have employees and so forth, they now probably have a business and they have a job in their business, right? So most people with self-directed accounts aren't looking for a job because that takes a lot of time. This is the place where real estate investors start most generally when they don't have very much or any money to invest. And that certainly was the case for my wife and I. This is where we started, but now we are doing almost none of these types of activities anymore. Semi-active, we'll just use rental properties, for example. And we'll stipulate that these rental properties, whether they're short-term rentals or long-term rentals or pad splits or whatever the case may be, these are residential properties. They could be commercial properties. But in all those cases, let's stipulate that they are going to be third-party managed, right? Making them a more semi-passive investment. Understand that there are always decisions that are going to be made, even when you have a management company working for you. There's still work that's going to have to be done. And what we do, we kind of look at that as managing the manager. I was actually last week speaking at a real estate group in Columbus, Ohio, and a guy, I was talking about how to build a profitable rental portfolio. And a guy walks up to me at the end and he says, look, Tom, he says, I already have a fairly large portfolio of rental properties, but I'm having a hard time finding a management company that will manage them the way I want them managed without me having to tell them what to do all the time. Do you have any advice for me? And I said, yes, I think you have 2 options. 1 is get used to it, or 2 is start your own management company or self-manage, right? Because we call it managing the manager. You're not unless there's just a unicorn out there that I have not been exposed to, there aren't very many management companies that you don't have to be involved in and, kind of walk them through what you want done with your property. They're always going to have questions for you too. Not their fault. They're going to be emailing you or calling you saying, hey, we have this issue. How would you like me to handle it? So there are things that have to be done. That's why I put rental properties that are third-party managed in a semi-passive bucket. But looking at them and grading rental properties on the 4 categories we're going to grade on, how much risk is there to rental properties? Is this going to be a high risk endeavor for our trust account, or is this a low risk endeavor? And I'll give you a second to think on that question. And I think, obviously there are arguments that could go both ways, but I think in general, rental properties, because of their common appreciation over time, I think if you're going to buy rental properties and hold them for the long haul, they are going to be on the lower risk scale, lower part of the risk scale. On the time commitment, I think rental properties, again, are going to be kind of in the middle to lower side of the risk scale, or excuse me, of the time scale, if they're third party managed. And then knowledge of investment. This one I think is going to be in the middle. The biggest challenge I see with people buying rental properties as an investment is they don't know what kind of rentals to buy. What makes for a good rental property? And ironically, that was one of the things that I covered in my talk last week in Ohio, was what makes for a good rental property. If you don't know that answer and you go out and buy, 4, 5, 6, 10 houses in your self-directed account, you may have the wrong houses and you may have challenges. So when it comes to knowledge of investment, I would put rental properties in the middle of the knowledge scale at about a 5, because I think you do have to have knowledge of what kind of investment to buy, what type of property makes for a good rental property. Not all properties make for a good rental property. And then lastly, investment time horizon and payout frequency. I put this one on the higher part of the scale because payout horizon is going to be a while. If it's a rental property, inherently you're buying this to hold for a while. You're not just flipping and making a short-term investment. So the payout off of that is going to be a long time horizon. So excuse me, that's kind of some of the things that we would look at when looking at rental properties as an investment strategy. Now, another semi-passive investment we've mentioned is note investing or private lending. This may seem a little bit more passive than rental properties, but honestly, it's not any more passive than rental properties unless you're not doing it correctly. Rental property purchases are going to take the bulk of your due diligence on the front end, and note investing and private lending will as well. It requires a great deal of research and due diligence before that investment is made. It's also going to require a fair amount of servicing and oversight after the investment is made, which is, again, very similar to rental properties. And then it's also going to require knowledge of the project itself. If you are going to lend to somebody that you purchase, that you met somewhere along the line that is an active investor, you're going to provide them the money for their flip. I would say that you would not want to do that loan unless you had a very good knowledge of how to do that flip yourself. If you ended up having to foreclose on that property and ended up owning the property in your account. A lot of people I see do loans out of their IRAs or otherwise, and they have no knowledge of how to flip a house. They have no knowledge of the construction process.
and how to handle that. And then when they end up having to foreclose, it is a huge problem for them. In fact, it's such a problem, most of them will drag their feet on foreclosing and make it even worse because they drag it out so long before they take ownership of that property and are able to handle that foreclosure or REO. So there is an amount of knowledge that needs to be possessed before you get into note investing and private lending. Now, obviously, that's all available. There are classes, there is stuff online. It's certainly something that you can get the knowledge of, but I think you'd want to do that prior to actually lending out of your account. When we do due diligence on a private lending note, any one given note will create a 3-inch tall 3-ring binder of due diligence before we fund that loan. Now, think about that for a second. Every note we write at Investor Loan Source creates a 3-inch tall 3-ring binder of due diligence. Now, at the NuView Expo several months ago, I actually did a talk, as Nate alluded to, on due diligence and all the things that we go into to determine whether a borrower and a project is worthy of us doing a loan for. And again, if you're going to do any private lending out of your account, you definitely want to gain that knowledge before you start doing that. Syndications. Now we're switching to passive investing, totally passive investing. Syndications. We talked about this one earlier. This is a group of people pooling money together to purchase an asset. Now, the asset is typically going to be a commercial property. Now, think of one investment, but many investors putting their money together to purchase that one investment. It doesn't have to be just one investment, but most syndications are a single asset syndication. Now, the lead investor is the person that has the knowledge and certainly, hopefully, the experience to pull off this transaction. They are going to be an active investor. So in this scenario, they are in an active role. They're the ones that are the boots on the ground. They're the ones making the decisions, and they're the ones with the knowledge and experience to pull this deal together and make it work and hopefully make it successful. The other investors that are involved in this transaction are going to be totally passive. They're going to bring the money for the deal. They're going to bring maybe a credit score. Maybe the active or lead investor doesn't have a high enough credit score to pull off this big of a deal. So one of the passives may have a high credit score, and they might be willing to get into the deal to bring that credit score to bear and be able to get that loan for it. Others might be getting into the deal to bring net worth requirements. To get a large commercial loan, obviously there's going to be a certain net worth requirement of the group, and one of the other investors or passives may have a strong net worth that the bank would like, and they'll be able to do that loan. This purchase is going to be made with the general goal of payback. It's a general goal for the payback, but it is not set in stone. Now, that payback of the principal that the investors are investing is called a liquidity event. Now, the most common types of liquidity events in a syndication is going to be the sale of the asset or the refinance of that asset. Now, let's talk about these a little bit more in detail. You've got a group of people come together. One has the experience and knowledge. They're going to be the active investor. All the rest of the people are bringing the money. And by the way, the lead investor may have some investment capital involved as well, but they're not going to have the bulk of it. But they're going to go out and purchase a property. So a common one, and one that we used to do, was we would go out and buy an apartment complex that was distressed. So the complex is not making any money yet. It's got down units, it's got deferred maintenance, it's got a horrible tenant profile. So we would go in and fix up this complex and lease it up, and then we would flip it or sell it. But unlike a single family flip, this may take 2 years, 3 years, 5 years to accomplish. So in that time frame, you may be getting a check, you may not. Obviously, while it's underwater or unprofitable, you're not going to be getting a check. Once we hit profitability, you might be getting small payouts, and then you'll get your big lump sum liquidity event when we sell the property. And that's a great investment strategy, but you can kind of see some of the downsides to it, right? From the risk profile, it can be riskier. Time, it's going to take 0 of your time once you have done your due diligence on the lead investor and on the project itself. After that, it's just sit back basically and let them do their job. Knowledge, not going to take a lot of your knowledge because that's what the lead investor is for. But time horizon and frequency of payout may be the downside on that one. And then the last one we'll talk about is fund investing. This is a group of people pooling their money for the purchase of multiple assets. So in this case, think many investors and many assets. Now, I had Alex, my assistant, look up, we have 2 private equity funds that combined have 175 limited partners. That is people that have invested in those 2 funds for a total of just under $43 million. With that money, we have purchased real estate loans or notes from our lending company. So that money holds a lot of different notes. So in this case, you have fund managers who are, by the way, also investors in the fund, but in a minority percentage. And this is done so that the interests of the manager align with the interests of the LPs or limited partners. The limited partners simply bring the capital. They put the capital in, and then the managers bring the knowledge, expertise, and typically a team of people that will do whatever the investment strategy of that fund is. Our fund, again, the investment strategy is to purchase real estate notes, private lending notes, and we hold those for a yield for our investors. But you can also invest in funds that do all sorts of different things. Not all of them are funds for notes. Investing in a private equity fund is a truly passive investment because you have no work to do, you have no decisions to make, and you have no management oversight. Your work, just like with syndications, is confined to your initial due diligence on the fund manager and on the investment strategy of the fund itself. Now let's look at some pros and cons if I haven't already hit them. I think rental properties, I hammered those pros and cons pretty well. But I think one of the pros to rentals is the wealth building strategy through appreciation. I didn't really touch on that. And one of the big cons on rental properties is you're at the mercy of market cycles. Meaning, for example, right now, real estate has been going up for what, 9 years, 10 years, 12 years? I don't know. I've lost track. It's just been going up and up and up. And you might think to yourself, well, this isn't a good time to buy because we're at the peak of the market. I'm not saying we are or we're not. I don't have a crystal ball and I'm not going to speculate, but we are at the mercy of market cycles when we are purchasing rental properties. And a lot of people are challenged if they purchase properties right at the peak and then property values fall in the ensuing 2 or 3 years. I would say if you have a really long time horizon of 10, 20 years, I really wouldn't worry about that much because over time that will make itself up and then some. But if you had a short time horizon, the market cycle could certainly come into play. With note investing, with long-term notes, obviously the market cycle would become an issue. But if you're just doing short-term hard money notes, it's not really as market cycle sensitive, because those notes are going to pay off in a short time frame, hopefully, right? If we've done our due diligence correctly. And when those pay off, you can reset your interest rates with new loans as the market changes. Other cons to private lending is a lot of times, especially a trust account investor, may concentrate too much of their dollars, or let's say too large of a percentage of their account, in too few deals. For example, somebody that has, let's say, $250,000 in their self-directed IRA may not want to do a $220,000 loan for somebody on a hard money loan because that's too high of a concentration of their available dollars into too few deals, in this case, only one. Syndications, pros and cons. You have the potential for higher yield in some of these. My business partner was in a syndication that, just hit a home run out of the park and returned a 35% annualized return. That is stellar. That's phenomenal. However, on the con side, I've also seen syndications not return a single dime and actually lose money and have capital calls in the process. So it's a much higher risk profile in the syndications most generally. Another thing I do like, though, about syndications is you can leverage the experience of an expert. Another one of the cons, again, is the frequency of payout and time horizon. Those can be long, particularly on a commercial property. And then lastly, the pros and cons of fund investing. I like fund investing more and more as I get older, and my stage of life gets more and more to the point where I just don't want to do stuff I don't want to do anymore. Fund investing is just easy. It's a truly passive investment. It diversifies your money among a lot of assets, utilizes professional operators and managers, and it's really easy to get to know the fund managers. And in full disclosure, I said I do run and co-manage 2 private equity funds myself, but I also invest in other fund managers' funds. I don't claim to know everything. I don't claim to be an expert at everything. So when I find an expert in something that I don't know about, for example, we are invested in a fund in Florida that owns 4 assisted living facilities. Now, I don't know anything about assisted living facilities, but I've met the managers. I know everybody on the executive team. I like them. I trust them. They are true professionals. So we put a little bit of money in their fund, and we're quite happy with that. Now, the cons of investing in a fund is lockup periods. You want to make sure that before you invest in a fund, you ask, what is the initial lockup period? That is the length of time that after you have put your money in, you can't pull it out. It has to stay in there. In our funds, we have a very short lockup period as far as funds go. Our lockup period is only 12 months, but I've seen lockup periods as high as 3 years and 5 years. Again, that's not a bad thing if you have a long time horizon and aren't going to need that money. But if you have a short time horizon, that may be a challenge, and certain funds may be more advantageous to you than others. The other con of fund investing is if you're not a accredited investor by the SEC or Securities and Exchange Commission guideline, oftentimes you can't get involved in those investments. And full disclosure, our funds do require, because they are a certain type of fund that is regulated by the SEC, we do require that our investors or LPs be accredited investors. So with that, there is a lot of things to consider before you wire your money out to a particular investment deal. I hope that this has been helpful for you in kind of in your mind, putting all these different investment strategies in some type of an order, and then also giving you 4 things to use as considerations each time you look at a real estate type investment and decide whether that strategy is going to be good for you or not. With that, I am going to turn it back over to the NuView team and apologize. I believe I went over by 2 minutes. I tried to do better than that, but I'm sorry.
Shame on you, Tom. 2 minutes.
I know. Horrible.
That's much better than me. I usually go way longer than 2 minutes. I wrote a couple things down because you brought up so many good points. First, I do want to say, I have actually seen with my own eyes Tom's due diligence binder, and he is not exaggerating about how thick it is. And with that being said, speaking from the IRA custodian perspective, it's really important that you look at what Tom said, because a lot of people miss these points. And I'll just go back to one of the most recent things you said, Tom, is these syndications. Syndications can be a great investment, but you also have to be aware of when the payout schedule is and where you're at in retirement. It's probably not going to affect you if you're in your 30s or your 40s, but it may affect you if you're in your 60s and 70s and ready to retire. Depending on your stage of life, it may change the types of assets you want in your retirement account. You may want to think about having rental properties or even notes that are generating monthly cash flow on rents and interest payments. I've seen a lot of clients take that approach and live very, very nice retirements through their self-directed accounts. Another thing I would add too, when you're talking about self-directed accounts, there's certain accounts, and you can get, this can be fun. There's certain accounts that benefit today and there's certain accounts that benefit later. That's always something you can consider when you have multiple accounts. And I'm talking to the people who self-direct not only their Roths and traditionals and their employer plans, but people that also self-direct their HSAs and their ESAs. Those are 2 very unique types of accounts. And sometimes the investment based on when the income is realized might fit better in one versus the other. HSAs and ESAs, the profit can be taken out the next day you make it and pay for health expenses and education expenses. You don't have to wait until retirement. So that's something that you can also think of too, is identifying which investments fit better in my HSA versus my Roth IRA. Another thing that you said, Tom, that I really liked is time. How much time do you really want to spend on your IRA investments, especially if you're a real estate investor? Your time and your focus should be on the deals outside of your IRA, because that's probably how you're feeding yourself. But your investments inside the IRA, you shouldn't want to spend time on those. Your IRA investments or your retirement should give you more time in retirement, not take more time away from you. So those are just a couple things that I pointed out or that I picked out, Tom. I want to see if there's any questions here. If anybody's got questions, go ahead and type them into the chat box. Tom, is it okay for people to email you? I know a lot of our viewers love having the slides. If anybody wants a copy of the slide deck, is that shareable if they shoot you an email?
Yes, absolutely. Just shoot me an email. I've got my email right there on that last slide, and I put it there. So if anybody has follow-up questions, I live, eat, breathe, and sleep this stuff, as you well know, Nate, because we've known each other for so long. I just enjoy sharing knowledge and information because I've learned so much through the last 15 years doing this thing, and it's just really cool to be able to share that with other people and watch them grow as well.
And I want to share one more thing. For those of you who don't know Tom's kind of history in investing, one thing I wanted to point out is he uses both sides of self-direction. And what I mean by that is, if you are an investor, you should understand how to use your own self-directed IRAs to plan for your own retirement. But if you're looking for private capital, it's also a great source of private capital by using other people's IRAs, or we say OPI. There's $37 trillion in retirement accounts. It's the largest source of Americans' wealth. And if you can understand how to self-direct your own account, that unlocks the door to be able to talk to other people who might not have an investment, but you can deploy their money safely and securely and borrow money without using your credit, without using your income. And I know Tom started out in the industry. Can you talk just a little bit about that, just real briefly, about how you started and how self-direction kind of helped you along with your real estate career?
Sure, absolutely. When we started out, as I said, a couple of times in the presentation, my wife and I started out broke. I mean, we were gone through a bad situation with the crisis of 07, 08, and we didn't have money to invest, but we found a lot of people with self-directed accounts that didn't have the knowledge we had in real estate. So we used their money, our knowledge. We would borrow those funds, give them a first deed of trust lien against the property that we were purchasing and fixing up. And we probably borrowed in a 4 or 5 year period, $18 million, I think is the last count. Now, we don't use that strategy anymore, but we do attract self-directed money in our funds. So over 50% of the $43 million in our funds is self-directed accounts. And those fund investors invest that money in our funds, and then we just use those funds to buy the notes from our lending company, Investor Loan Source, and then that recapitalizes our lending company so we can continue to do more loans. So it's just another way of using OPM, but instead of purchasing properties with it, now we're building a note portfolio that we allow other people to share in. So those limited partners that invest in those funds are getting interest off of all those notes in that fund. And it's just a great way for us to take a system that we built here in Houston and then take it to other people and say, hey, would you like to get involved? And, the returns are, low double digits with absolutely no work other than your initial due diligence to make sure that we're the type of people you'd want to do business with. And our fund is the type of fund that you would want to invest in. And once that is done, if you have made your decision, that is it. Your work is done. You just set it, forget it, and cash your checks or reinvest, whichever your choice is.
I will say this, you have helped a lot of people save for retirement through your experience and what you've set up there. I know a lot of people personally who have used you, use your experience as leverage so that they can live a good retirement. And we really appreciate, everything that you do. Not only in Texas, but everywhere. You're everywhere now. I went to that's so funny. I went to where were you? New Jersey, and I ran into Tom in New Jersey at the Private Lender Expo. That's right. So Tom, I want to thank you again. I hope that we see you at our next investor retreat. I think we're going to have it in July. I'll give you the details once we get everything locked down, but I'd love to have you out here again. And I know our clients are eager to spend some more time with you. So thank you again.
As soon as you know the dates, get them to me so I can block it off on my calendar and I'll be there.
All right. Thank you. And I hope you guys enjoyed it. Stay tuned or see us again next Wednesday for our Wednesday workshop. Thanks, everybody. Have a great day.